Two business owners sell their companies in the same week. Same sale price, $1.2 million. Same industry. One nets $910,000 after tax. The other nets $672,000. The $238,000 gap has nothing to do with their business performance and everything to do with how the sale was structured. The first owner spent 18 months preparing for the transaction. The second accepted the first offer, signed what the buyer presented, and only found out about the tax consequences after the wire cleared. The structure of a business sale is not a paperwork formality. It is a $200,000 financial decision. The first and most consequential structural question in any business sale is whether it is an asset sale or a stock sale. In an asset sale, the buyer purchases specific assets of the business, equipment, intellectual property, customer contracts, goodwill. In a stock sale, the buyer purchases ownership shares in the legal entity itself. Buyers almost universally prefer asset sales because they can step up the asset basis to the purchase price, generating future depreciation deductions. Sellers almost universally prefer stock sales because they generate capital gain treatment on the entire proceeds. This tension is resolved in negotiation, and knowing it exists before you accept an offer is essential. In an asset sale, different categories of assets are taxed at different rates, which creates a purchase price allocation. Negotiation that most sellers don't realize is happening. Tangible assets like equipment sold above book value generate ordinary income on the recaptured depreciation. Covenant not to compete payments are ordinary income. Accounts receivable are ordinary income. Customer list and relationships, goodwill, are taxed at long-term capital gains rates. Inventory is ordinary income. The buyer wants to allocate as much as possible to depreciable assets. The seller wants as much as possible in goodwill. Both parties must file Form 8594 showing the agreed allocation. The IRS compares them. Qualified Small Business Stock, QSBS, under IRC. Section 10202 is one of the most powerful and underutilized tax provisions in the tax code. If you incorporated as a C corporation and have held your stock for at least 5 years, you may be able to exclude 100% of the gain from the sale of your stock, up to $10 million, from federal capital gains tax. The requirements are specific: C Corp only, original issuance of stock, aggregate gross assets under $50 million at time of issuance, and the business must be in a qualifying trade or service. Planning a QSBS eligible structure at formation saves millions for high-growth businesses. The installment sale method under IRC Section 453 allows you to receive the purchase price over time rather than in one lump sum, and pay capital gains tax only as you receive payments. This has two potential benefits. First, it reduces the tax due in the year of sale, preserving cash flow. Second, if you receive payments across multiple years, you may remain in a lower capital gains bracket than you would if the full amount were recognized in a single tax year. The buyer also benefits from not needing to finance the entire purchase price through a lender. Installment notes are frequently used in seller-financed small business transactions. Depreciation recapture is the most consistently misunderstood tax event in a business sale. Under IRC Section 1245, if you've depreciated business equipment below its fair market value, which accelerated depreciation under Section 179 guarantees, the recaptured depreciation is taxed as ordinary income, not capital gains. If you took a $50,000 Section 179 deduction on a vehicle and sell the business when that vehicle's book value is $0 but fair market value is $30,000, you recognize $30,000 of ordinary income on the sale, not capital gain. At a combined 37% federal rate, that's $11,100 of additional tax that surprises nearly every seller. Engage a CPA with M&A transaction experience before you accept any offer, not after. The purchase agreement will include a purchase price allocation that you and the buyer must both live with for tax purposes. If you sign an allocation that's disadvantageous and later discover it, you cannot renegotiate it unilaterally. A transaction CPA reviews the allocation before signing, models the after-tax proceeds of different allocation structures, and identifies which categories to push back on in negotiation. This engagement typically costs $3,000 to $8,000 for a small business transaction and routinely saves 10 to 15 times that amount in after-tax proceeds. Opportunity zone investments provide a powerful after-sale deferral option. If you reinvest capital gain proceeds from a business sale into a qualified opportunity fund within 180 days of the sale, you can defer recognition of the gain until December 31, 2026. And if you hold the QOF investment for 10 or more years, you pay zero capital gains tax on any appreciation in the QOF itself. This is not a small benefit. $500,000 of reinvested gain that grows to $900,000 over 10 years exits with $400,000 of tax-free appreciation. Opportunity zone investing requires specialist advisors, but the mechanics are real and IRS sanctioned. Charitable Strategies can reduce the tax burden of a large business sale for owners with philanthropic intent. A charitable remainder trust, CRT, allows you to contribute appreciated business assets before the sale, sell inside the trust at zero capital gains tax, and receive a taxable annuity income stream from the trust over time, with the remainder passing to charity at your death. A donor-advised fund allows immediate charitable deduction for contributed appreciated stock or assets. Neither strategy is appropriate for everyone, but for owners with $1 million or more in gains and some charitable intent, these vehicles warrant serious analysis. The tax structure of your business sale is not a detail, it is the transaction. Asset versus stock sale, purchase price allocation, depreciation recapture, installment notes, QSBS exclusion, and opportunity zone reinvestment. Each of these decisions affects your net proceeds by 5 to 6 figures. Begin tax planning 18 months before any anticipated sale. For the fundamentals of what drives valuation and how to build a business that commands the highest multiple, Part 1 of the Exit Strategy series covers the full methodology buyers use to price your business.